Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you today, Martin?
Yeah, hanging in there. It's blooming cold here this morning, I must tell you.
Yeah, I've got the heaters on with a t-shirt on. Don't worry about that down in Tassie. But another interesting month with some high inflation prints and plenty else going on around the world.
It really is a rocky road at the moment, isn't it? So many things going on and so many people boxing at shadows, actually. Let's not let information get in the way. Let's just, pursue a particular thesis and never mind what happens. Yeah, we are in an inflationary episode at the moment where inflation is clearly stronger than officially being reported. And indeed, the Reserve Bank and other banks around the world now having to react, respond significantly stronger than they expected. No longer the word of transitory is in play. It's now, yes, this is our number one challenge, except, of course, that they could break something in the process, not least because inflation is so strong, they're moving rates up so quickly, but the flow of information showing where things are is delayed significantly, so they could definitely break something in the process.
Yeah, I think we touched on that last month as well about their wording and their rhetoric and how when things are changing so quickly, it calls them out even more so about how they're just one step behind and saying one thing when really there's another happening. And you've got some good slides that highlight that again today.
Yeah, we've got a few slides. Look, I'm trying to sort of mix it up each time we have this conversation because otherwise we're just going to show the same slides every time. But I thought we might start with just look. It's the end of the financial year, so end of June, and this is actually quite interesting. Just looking at a few different statistics around the world in terms of what the markets have done over the last year or so, right? And I thought I'd just go through a few examples. So tech has really had a bit of a bath. Like Netflix, for example, is down 66% over the last year, right? Which is not surprising. Whereas, of course, natural gas, 75% higher, or over 3 years, 177% higher, right? Natural gas is just very, very buoyant, not least because, of course, the Ukraine situation. Obviously, cryptos have not done so well over the last year, although if you look over 3 years, quite a lot better. But interestingly, iron ore is down. Well, it's 38% down from over the last year. That's a significant factor, I think, going ahead, right? And if you look at gold, it's hardly moved. It's 2% higher over the last year, whereas oil is 49% higher over the last year, right? So again, you can see some of these movements. If you look at the US 10-year, it's up 110% over the last year, which is pretty significant. And if you get down the list, some of the other techs are down as well. The Dow Jones overall sitting down 10%, but the Nasdaq down more than 22%. Of course, Nasdaq actually went 30 down, so they've come back a little bit now. Some of the banks not doing well. JP Morgan, one of the investment banks, down 25%. Wells Fargo down 12%. And if you come up to the local situation, the Aussie 10-year up 143%, so very strong growth in the Aussie bond. Whereas the Aussie dollar down a little. Real estate not doing good. REA Group down 34%. Woodside Energy, was petroleum, of course, up 47%. Whitehaven Coal up 157%. Iron ore down a little there. And then in Macquarie Group, sort of belying some of the banks, up a little bit. But then the ASX financials down 9% and the ASX 200 down 8% over the last year. And over 3 years, the ASX 200 just up 1.23%. So it puts things into context a bit, doesn't it?
Yeah, a couple of interesting takes from myself here. The Aussie bond market over 1 year and 3 years there compared to the US, it just kind of shows you how people did have that mindset of it's different in Australia, but really we're just following in the footsteps and everything's so interconnected these days. You can't have rates at zero in one place and not another, and then have inflation in one place and not another. So probably that was, to me, it says there's less smart money in the Aussie bond market, and now it's turning, and that's why we've got the bigger moves. Yeah. The commodities ones are interesting as well. But gold and this talk of inflation hedges, where a lot of people are harping on crypto, hasn't performed well in the past 12 months, and Bitcoin was meant to be an inflation hedge. Well, I think that's in the short term, we've seen so much correlation with all markets being dragged down as the inflation narrative takes over. And, I'm a big believer in gold and silver longer term as well. But if you're going to say that stuff about Bitcoin, well, you can argue that gold's only moved a few percent in the past 12 months or whatever. So it's neither here nor there. And these bigger macro things take time to play out while there's this short-term noise and short-term focus.
No, I agree with that. I mean, what I would say is that the commodity stories, right? I mean, if you look at those numbers, they're huge. And of course, Australia does have a very significant commodity story to play. And that's one of the reasons why some people are saying the Aussie economy is perhaps better placed than others. On the other hand, we're exporting a lot of stuff to China. I think 37% of all our exports go to China, and a lot of the liquid natural gas is going to China at the moment as well, right? So we are somewhat exposed to those commodity waves. And I guess the question is, what happens if those things turn? They might not, they might, who knows? But I think the other point to make is, Alex, is that really we're aping the US market, and what the Fed is doing and what the Australian Reserve Bank is doing is very much aligned, not surprising, and actually seeing quite a lot of other movements. When the US goes up, we go up. When the US goes down, we go down. So it's like we're a little cork on a big ocean here, but you got to look at what's happening in the US, which is why I spend a lot of time looking at the US, because actually, really, that's the biggest game in town. That's the most significant for our markets too.
And China's obviously fast growing and also going to be soon the biggest game in town by a lot of metrics. Do you have any thoughts on that Australia relationship with China? We've recently seen Anthony Albanese tour around and talk about these countries that he wants to strengthen ties with. And I'm sure a lot of our viewers have gone down this rabbit hole about the AUKUS, where we're trying to strengthen ties with the UK and the US, Canada and New Zealand, versus our number one trade partner, China, and that friction. And do you have any thoughts just in general, and if Labor's going to be...
Yeah. I mean, it's an interesting question because Labor is trying to sort of open a little bit of dialogue to China, and we're clearly very exposed. I mean, two things about China. The COVID thing is still bouncing around there, and they're talking about that continuing into next year. Their economy is not behaving anything like the Western economies. Inflation is not a problem there at the moment. In fact, they're stimulating their economy, right, at the moment. But they're also not building as much. So if you look at floor space starts in China, they're way down from where they were, so they're just not building as much. So the question is, how much more steel will they need? And it's a very interesting question. So I think the problem we've got at the moment is there are people in Australia saying we've got to decouple from China, we've got to find other markets. But the reality is we are so dependent still on what happens in China that we need to be, cozying up to them a little bit and trying to actually establish some of those dialogues. And it's sort of trying to make a conversation happen with a country that is big and assertive and is wanting to expand its power base down into Asia Pacific and beyond. And I thought it was very interesting that they announced the Western equivalent of the Belt and Road Initiative, in the last couple of weeks. They're trying to sort of counter what China's been up to. This has got a long way to play. I think we're caught in the middle, but I don't think we can walk away from China because so much of our economy is reliant on what happens in China.
Yeah, and one thing I had to laugh at, I think a few days ago, China said they can maintain this lockdown and zero COVID policy for up to 5 years if they have to, whereas in the West, the message is, everything's fine and we're going back to normal, even though we've got the highest levels of vaccination in the world, and yet we've got all these, record case numbers and overflowing hospitals, and it's just funny how things that were considered conspiracy 2 years ago have come out to be fact and vice versa. So yeah,
we live in a strange world, and of course in the UK they've now got the next two variants of COVID bouncing around, and they've got some of the highest numbers there. So this COVID thing ain't over yet.
No. All right, on to the next slide, Martin. Household wealth and how that's changed with the fall of house prices and markets and so on.
Yeah, this is interesting. This came out from the ABS, and it's quite fascinating just watching that the non-financial assets increased. So in other words, the value of land and houses went up, right? Whereas the financial markets went back. And in fact, household liabilities went up. Because we're borrowing more. The credit numbers just out today are also quite strong, which means that overall the growth in net wealth is up a bit, but not as strong as it has been. And I think we're going to see this go into reverse because now house prices are beginning to slide back. I think that people will be borrowing a little bit less, and I'm expecting the main financial markets to continue to go south. So it will be fascinating to see whether we get into a negative wealth loop now, I think it's quite likely. And if you have the view that wealth and the feeling of wealth is a really important factor when people make decisions about things, this could be quite significant. But at least the ABS put a stake in the ground to say, well, actually, a lot of our wealth is in housing. Well, let's see where that goes.
Yeah, so this data was only up till March, wasn't it? So as we start to see those hikes flow through, it's hard to see housing continuing to go up for the short term. But in some countries, we've already got a lot of that data rolling over and suggesting, I think it was that Germany could be in recession as soon as next quarter. And I view this as the excuse for central banks to say, oh, look, we're going to have to step in again, more QE, drop rates again.
Yeah.
But can they do that if inflation also stays high? That's the big rock and a hard place.
So they're caught absolutely now. So they need to actually deal with inflation, but they also need to try and keep the economies from falling over. So yeah, it's going to. I think rates will go up, then they'll come back down again. The timing is the question, right? And it depends on how stuck inflation is. I think inflation is way more embedded than many people think. I think that the energy prices will continue to rise for a long time. In Australia, of course, we've got a major issue with East Coast energy in particular, and there are reasons for that, which I won't go into now. But if you want to hear a really interesting discussion about that, go across to my channel. I spoke with David Llewellyn-Smith yesterday, who really pulled apart why we've got such a huge critical crisis in energy in Australia, and the fact that the Albanese government could do something to solve it if they've got the political will. But the question is, have they? So watch that space.
And the link to Martin's channel is always in the description below, guys, if you want to check out any of those videos. So next up, Martin.
This is the census, right? So we got the first trickle of data out of the census. The interesting observation first is that millennials, there are now as many millennials as there are baby boomers, right? You guys are taking over the world.
I was going to say, Martin, well, this is good for our audience, isn't it? The two biggest contingents. But
yeah, exactly. Well, baby boomers presumably will, start to slide off the perch in the years ahead. So the millennials are there, and it is fascinating now that I'm not sure that a lot of people have woken up to the fact that millennials are now, a significant force to be reckoned with. They think differently, they behave differently, their use of social media is different, their actually financial needs are different, and their aspirations are different. So I wonder how many corporations across Australia really understand that.
Yeah, a couple of things that I've seen in the past month of note. We're seeing trends where millennials prefer cryptos over mutual funds, which is interesting. Whether or not that's a bad thing and it's too speculative and it doesn't bode well, whatever, I'll leave that up to the audience. And the other thing was birth rates in some of the European countries, after being very steady, 1% year-on-year changes, have now fallen 10%. So whether that's a COVID-related thing or fears about the future, whatever it is, but people are having less children for the first time in a very long time.
Yeah, actually, population, evaporation is a thing we're going to see. China's got that problem at the moment, and a lot of other Western countries have too. One of the reasons there why people are fighting for migrants, right? They're trying to sort of boost their own population by bringing people from other countries. And, I wonder how much more will be offered to migrants to attract them into particular countries in the years ahead. That'll be interesting. On the census, one other interesting piece of data, more than 1 million vacant properties across Australia, right, in the official census number. More than 1 million. That's a scandalous number, and it's understated, by the way, because it doesn't include all of the newly being constructed stuff that's there at the moment as well. Probably closer to 1.25 million. Lots of rubbish being spoken about undersupply if so many vacant properties exist.
And if we go into that data a little bit more, Martin, are these people that own multiple properties? Are these properties sitting vacant and people don't want to rent them out? Like, what is the main reasoning for all these properties to be vacant?
So they don't actually go into that, but my surveys do. So we know that there are some people with holiday homes, which they go down there a few weeks a year. We know there are some people with Airbnbs, which are vacant, not always occupied. But there are also a lot of people who are holding property vacant deliberately. And if you look at some of the high-rise, for example, down in Docklands in Melbourne, right, we see a lot of foreign investors who bought some time ago and are sitting there just watching the value of their property hopefully go up. But they don't want to actually tenant it because, of course, that would actually mean wear and tear. So they keep it in pristine condition and just sitting there as an asset. So a lot of Asian investors do that. And so that's another factor. I think there's a big conversation to be had here about how we release some of this free accommodation back into the market. Do we need to give tax incentives? Do we need to put penalties on vacant properties? Some states are starting to go down that route now. I think there's a really important conversation here because there are lots of people homeless. There are lots of people living in cars, and yet we have a lot of property that's actually not being utilised at the moment. I think we need a really thorough review of this, and I think this could actually be one of the important levers that could be pulled by the new government to try and actually alleviate some of the critical housing crisis issues that we've got with very low vacancy rates, very big rents, and of course a lot of people struggling with housing overall. So this was a big deal. There's going to be more data coming out later because the census drips data out over the next few weeks. I'll have a look at that in more detail and see what else I can read later. But I thought it was a really interesting statistic and probably one of the most significant ones.
Yeah, I agree in that all the policies that have led to this inflated housing prices in Australia and concentration of our economy in proportion to building and all that. And then you see this problem where someone can go, well, I'll keep my flat or apartments, the house I own in pristine condition, and then I can borrow against it. And it just furthers that inequality. There's people out there that can't get a home. And then there's these reasons and incentives not to actually put it out because you can actually borrow more and keep the bubble going. It's crazy, yeah.
And just saying we're going to build more and solve it that way, it doesn't work. I also think we need a social housing policy that really works, right? That for me is the other issue. We've really done ourselves no service by effectively just getting rid of social housing and just leaving it to Mr. Market. Well, Mr. Market messes with people's minds. Mr. Market doesn't provide housing, which should be somewhere to live, not just an investment. But hey, I'm preaching the old gospel again, aren't I?
Yeah, it's not really a free market with all the things we have in Australia. The cash rate, the yield curve, it's come down a little bit in November 2023.
Yeah,
but still well
so
below the current cash rate.
Yeah, we were actually over 4 at one stage. This is sort of the forward view from the ASX 30-day. But look, it's still going up, right? So the expectation is from the markets that we're going to see a cash rate well over 3% into next year and probably higher. The Reserve Bank is saying rates will go up further, but not as high as that. And there's a big debate at the moment about how high rates will go up. Look, I must tell you, if rates go up towards 3.75 to 4%, that would absolutely kill the housing market and it would actually crush many households. So my expectation is that rates won't get that high, but they are going to go up, and people are already now shocked by how much they are going up. And I'll show you another slide a bit later, looking specifically at the fixed rate impact, but we'll cover that as a separate conversation. Right, this is a big deal because this is the same sort of picture now we're seeing in multiple markets, the US the same, the UK the same, right? Expectation is that cash rates are going to be much, much higher. Flows through directly into mortgage rates. And whilst there are some upside for those with savings, the old deposit rates are a bit higher now, the net effect on the economy and on small businesses could be extremely difficult. And that's why, as we said earlier on, the Reserve Bank and other central banks have now backed themselves into this corner, into this cul-de-sac, and there isn't really a way out. So especially when you think that inflation is partly being driven by international issues and commodity prices, and also, of course, by the fact that they did all this quantitative easing earlier on. And there's a lot of narrative trying to explain that actually inflation was caused by Ukraine, etc. But no, inflation was there before. It was already going high beforehand, right? So the real truth is this has been caused by central bank stupidity over the last few years. And what they're going to do is to try and actually solve one problem by lifting rates, but they'll probably create another problem. I'm afraid that I am very skeptical of central banks' ability to manipulate those levers and magically create a soft landing. I think it's unlikely.
One thing that I haven't heard a lot of people talk about is if central banks are in this hard place and they have to make these hard decisions, and if inflation affects everyone, the whole economy, if they can't control that, versus the housing market, and people saying, well, they can't raise rates because it would crush the housing market. But because Australia is stuck in this place where it has to basically emulate whatever happens in the US and these other Western economies in terms of rates, it's going to hurt us more than the US, where I think bank lending for housing is at least twice as big in Australia as it is in the US.
64% here, it's 30-something in the US, and pretty similar to that in other countries too. Yeah, we're over-leveraged to housing. 20 years of bad policy, 20 years of encouraging people to pile in and cut rates and make bigger loans. And in fact, in a couple of charts time, I'll show you the impact of that, because this is now coming home to roost.
Yeah. All right, moving on, Martin. Consumer confidence had a little bit of a bounce last month.
Yeah, very small amount, but still, look at where it is. It's literally in negative territory and very, very low. This is replicated in most other Western economies too. So in the US, in the UK, consumers are really worried about what's going on at the moment, right? And of course, when consumers are worried, the first thing they do is potentially hunker down a bit, spend a bit less. We'll think about that in a few slides. But the point here is consumers are quite concerned. And in fact, if you go to the next slide, one of the main reasons is inflation. So consumers have now an expectation of a 5.7% inflation, right? I mean, that's significant. So people are thinking, yeah, this is going to get worse. Rates are going up. Inflation is going to be a real problem. They will modify their behavior, partly because they'll have to, because they've got less free cash, and partly because the forward expectation means that they're going to actually start hunkering down and start taking different decisions. And I'm of the view that these inflation numbers and the fallout in terms of consumer confidence is a very important leading indicator of what's going to happen, right? Because what consumers do is critical, because more than half of our economy and more than 2/3 of the US economy is driven by consumer consumption. So if that goes off the boil, we'll have a major issue.
Yeah, just quickly before we get into those next slides, I think I just wanted to mention that we talk a lot about sentiment, and it's so hard to change once that sentiment flips or turns to the average person that didn't really know or care about inflation for the past however many years. And now they're starting to see it in the news and hunker down, increase their savings and all that. And on the flip side of that, we've got the RBA and these central banks, which have been so wrong. And I think we're launching an inquiry into RBA policy and whatnot. But yeah, these things all come home to roost in terms of the RBA are going to continue to say, oh, inflation's not going to be this. I think we've got this slide later on as well we'll touch on, but it's funny how that honeypot all comes together, and people are just sick of being misled or kind of bullshitted, I guess.
Yeah, the level of trust in central banks is absolute low at the moment. And of course, Phil Lowe went on ABC 730 a couple of weeks ago and tried to explain himself, but basically said, well, although I said that rates wouldn't rise until 2024, if you'd listened to me, I said, assuming that our assumptions about the economy are right, and they weren't. I mean, that was a disgraceful wriggle out, right? Try to explain the unexplainable. The fact is, the RBA's got it so wrong for so long. And now the question is, well, why would you believe them now? When they say that, well, inflation's going to come down next year and it'll all be fine. I'm afraid that the data that they're working with is rather lagged. It's rather limited, and I have very little confidence that they actually know where they're going to end up. And I have to say, other central banks around the world may be in a slightly better position, but I'm not sure that they are. They're going to break something. They're going to actually create potentially recessions and slowdowns. And interestingly, one of the most recent updates from the US showed lower growth than people expected. So as they reset some of the earlier numbers. So this is going to be the very important point to watch, because at some point, then will central banks have to say, oh, hang on, we've overshot, and or do we try and get inflation down under control first? They have got themselves this mother of a problem, but with no trust now.
Yeah. All right, these are some interesting three charts, Martin.
So this is
serviceability policy.
So this is from the APRA update. So there's the quarterly property exposures. I thought it was quite interesting. Point 1 on the first chart, we've got a higher number of loans now being written with serviceability and exception waivers. Right? That should be worrying people, right? So more people are actually being allowed to have loans outside standard conditions, right? The second is, if you look at the one on the top right there, the share of new residential mortgage term loans, debt-to-income ratio, we've still got quite a few people with a debt-to-income ratio of 6+. Now, APRA defines 6 as risky and above, right? So we're still getting people loans at 6 times plus. And it's come just slightly different from where it was, but that's a problem. And then the third one, down at the bottom there, the loan-to-value ratio, we've still got high loan-to-value ratio loans being written, despite the fact that house prices are now on the way down. These charts suggest to me that the regulatory environment for loan lending is not where it should be. And in fact, APRA wrote quite recently to the banks saying you need to be much more careful about your risky lending, right? So expect to see considerable changes ahead in terms of what people can actually get in terms of loans, because the banks are now starting to hunker down a little bit. But these statistics should worry anybody who's thinking about the broader economy, because there's risks here.
Mike, could you just break down those exceptions and the waivers, and maybe give people some real examples of how that works?
Yeah. So basically, there are certain rules and things that are coming from APRA, but there are also internal rules within the banks, right, about what proportion of income they'll take and how they look at expenses, all of those things. And basically, if you work within the standard guidelines that they work within their banks, they can write the loan. But if you're outside those standard ratios, and they might use some of the standard expenditure ratios that are used, if you're outside of those, for example, if your income's really big but your expenditure is big, they might say, well, actually, we still think you can afford it, and therefore they will break their own rules, their internal rules, to still write a loan, right? But the point is that if those rules are there for a reason, the fact that more banks are breaking them more often now tells me that they're more anxious to try and write loans than they should be. So I think that I've always looked at these exception statistics as one of those leading indicators of problems ahead. And we know there are a lot of people who are fine, but there are a lot of people who aren't. And unfortunately, new borrowers, recent borrowers, are still going to the bank and getting a loan with a 6 times plus debt-to-income ratio, high LVR, and they're breaking rules in terms of some of those other ratios too. So that's a real problem.
Yeah, and great explanation, Martin. The reason I wanted to touch on that so people understand, I think we set a dangerous precedent after the GFC when we did the bailouts and whatnot. And if you're a big bank and you know you're too big to fail, and banks as a percentage of economy are even bigger in Australia, they almost know that if anything bad happens, they're going to get these QE rescue packages from the RBA stepping in to buy mortgages and mortgage-backed securities. And it's just that GFC pattern all over again, where they're going to write these things because there's higher rates coming and people are probably buying these mortgage-backed securities and one at the moment. And they almost know the worst-case scenario is that the RBA will buy them off them and won't let them fail if things go badly. Yeah. So something interesting if we'll be talking about that in years down the path. Yeah,
no, exactly right. So the international markets assume that our major banks in particular are too big to fail, and the government will always support them. Now, of course, the other argument is, but then would they bail in deposits and things instead? Well, I don't think they will. I think more likely we're going to get bailouts from the government if things go pear-shaped. Hopefully they won't, but there's always a risk. But you're right. It's one of those things where the credit rating of the banks are more linked to the credit rating of the country than anything else.
Yeah.
Work that out.
All right. Okay. Fixed rate mortgages.
Yeah. So there's about 500 billion of fixed rate mortgages going to actually reset over the next year or two, right? And pretty much all of those are going to be much higher. So fixed rates were at one stage 1.99%. Now they're at 4, 5, 6%, right? This is the other factor that is inevitable, right, with high rates. And it's worth just looking at the spread of those fixed rate loans. At some stages, we had large proportions, 45% of all loans being fixed, right? So this is another problem. And it's a bit like the adjustable rate loans problem in the US in the global financial crisis, because it means that ahead people know that their rate is going to step up. And, if you go from 2 to 4%, well, that's equivalent to a 30% increase in your monthly repayments. So this is huge, right? So this is 500 billions of loan, right? And there's about 2 trillion out there. So a quarter of our mortgage lending is up. That's something to watch.
Yeah. And here you've got the estimated borrowing power. And one thing I always like to say is that a house is only worth what a bank will lend someone, and people often forget that.
That's true. And so the banks have their own internal sort of limits. But basically what's happened now is, on average, borrowing power has already dropped. In other words, if you stood up to a bank last year with the same income and expenditure and said, how much can I borrow? And compared now, they'll give you 10 or 15% less now. And the point is, as rates go on going up, because the buffer rate goes up as well, so it's always 3% higher, it's naturally going to be, a reduction. And of course, they're now getting tight pressure from APRA to be more considerate for high risk loans, and they're dialing back some of those. And we're also hearing continued stories now of valuers valuing down property because they're worried about the fall in property prices, particularly apartments, but now also some houses in some areas too. So the net effect is people will be borrowing less, and the net effect is house prices are going to come down. And the reason this is important is because 2 years ago, when we had the COVID run, they cut rates and reduced effectively the hurdles to borrowing. Now we're in a situation where rates are going up, borrowing is being tightened. Have no doubt this is going to put downward pressure on house prices.
Next up, you've got one example, Waterford, but we've already seen a few of these. And I guess, could you touch on some of the fallout and what we've seen with people that were putting down deposits for these apartments, or they've just bought the land and then they go into liquidation and that process for people?
So this is a real unfortunate story, and not just this particular one, but there are hundreds of construction companies now under pressure. Some already failed because they've had a profitless boom, right? Thanks to poor government policy through Home Builder, thanks through the pulling forward of people. People contracted to have properties built at a fixed price. They haven't yet had that constructed. Cost of materials has gone up dramatically. Steel's doubled in some areas, other things too. They can't get the labour. And essentially now construction companies are failing, and they're starting to fall like flies. And not just small ones, but some of the bigger ones too. And I won't go through them in detail, but people will be aware of some of them. That means that there are some people who've paid deposits and signed a contract at a fixed price, and it won't be completed. And then the question is, well, do you walk away? Do you sell the land? Do you try and renegotiate? Do you try and find another builder? That's a nightmare, right? And unfortunately, we're seeing this not just a few times now, but we're seeing it significantly across the country, from west coast to east coast, from north to south. The building and construction sector is going through a really significant and torrid time, and we've not seen the worst of it yet because construction costs are still rising further. Inflation pressures are still there. Costs of labour are rising. And the cost of funding is going up. So I'm afraid we're going to see many more construction failures, many more disappointed people who signed on the dotted line to get something built, and it will probably never be built, or it will be built in a delayed fashion. And the other point to make is the other thing they'll do is cut corners, and so the quality of construction will also go down as well. Unfortunately, this is completely created by bad government policy.
Yeah, I'd be interested to hear some of these real world examples in the comments below, if you're a builder or if you've put down the deposit and it's happened to you, because I've heard different things in terms of who's legally liable, and a lot of people did have that set price, and then steel and lumber and all that has doubled. And then you've got the wait times on the shipping, and people have been pushed out a year, and then the monetary policy changes. So who is liable and what's happening and how that plays out is also getting interesting.
No, it is very important, and it's different in different states. So in some cases, builders have to have liability insurance, which means that you might be able to claim from the insurer. In some cases, they can pass the costs on. In other states, they can't. So it's a real mess. So you really need to read the small print in your contract, and also make sure that you understand how the environment is set in your particular part of the world, because the risks here are huge, and unfortunately, the end, person who signed on the dotted line ultimately is going to have a huge headache here, as well as the builders and other people too. It's a major issue.
Yeah. All right, monthly turnover, man.
Yeah, so this is retail, right? So retail was up 0.9% last month. Big surprise. Nobody expected it. Well, not many people. But there are two things that can create this. The first is more stuff, you're buying more stuff. The other is you're paying bigger prices for the same stuff that you're buying. And because inflation is so high, it doesn't surprise me at all that inflation is actually driving retail turnover higher. But that's not necessarily a good sign, right? And we don't really have, the appropriate adjustments for inflation in these numbers. So this is a bit of an artificial number. Watch ahead. I suspect we're going to find it weaker later.
Okie dokie. So this is a good chart, and we've touched on this in previous episodes, the impact that the RBA is QE program had, and if they want to ever unwind this, you can't be the biggest buyer of bonds and then just expect someone else to step in while you're trying to sell in a tightening environment as well.
No, this is a really interesting chart because this came from a US review of the RBA's yield curve control, right? It's a really good chart because it shows you just how much they intruded in the market and how much of the bonds they're sitting on, and they've got ultimately to, let them flow to maturity or whatever. They mess the market dramatically. This is going to have a significant price. But the other point I wanted to make here, the Reserve Bank also issued their own review of their yield curve control policy, right? Which was a much more positive. The market ultimately overtook us, but actually it worked for a bit. I would say if you want to get the full story of yield curve control and why it was such a failure, read the US report, not the RBA report, because it's just rose-tinted, the RBA report. This is a big deal. The amount of bonds that are out there. Quantitative easing, though, is still seen as a more appropriate strategy ahead rather than yield curve control. So if they do turn turtle and have to actually try and support the economy again, expect more quantitative easing rather than yield curve control.
Yeah. This is the one that I was looking forward to getting to. This is the RBA warning Australians, not to worry about inflation and not to get stuck in an inflation psychology. And as we've said many times, it's a worry because most of the time when the RBA says something, you should be doing the opposite.
Yeah, zig when they say zag. Yeah, it's interesting, isn't it? When inflation was really low, the argument was we don't need big wage rises because inflation's low, right? When inflation is high, the argument is you don't need or you can't have big wage rises because inflation's high and you'll make inflation worse, right? It's a nonsense argument. And I'm afraid that the whole idea of trying to talk inflation down, which is what the Reserve Bank has been doing, say, it'll come back, right? There's no evidence that inflation will, in real terms, come back. Now, the headline inflation may drop because if you think about it, it's the rate of change of inflation that actually drives the inflation number. But you could still be on a high plateau. You could still be spending a lot more on fuel, power, electricity, gas, food next month or next year. And it will still be horrible despite the fact that the inflation number could be coming down. So there's a real problem here. And unfortunately, I think this, for me, shows the weakness of the RBA in its position and the fact that the business lobby and the mainstream media are all advocating keep wage rises low. In other words, you got to take the hit again. And I'll just make this point. If you look over the last 20 years, the profit created by corporates has gone through the roof. Income growth for households has gone through the floor, right? We have a structural problem in Australia, which basically means that corporates win, households lose. That's got to change.
Yeah, I guess I want to reiterate Martin's final points there about when you see things like lettuce is $10 at the supermarket or petrol's $2.40 a litre, if inflation comes back down to 2%, that's still the rate of change of growth. It doesn't mean that lettuce is going to go back to $2, $5, whatever. It means it's going to keep growing, even if it's only at 2%, keep trending up higher than the current $10. Now, some of that has supply shocks and it's not an exact science, but that amount that you're spending from the cost of living in general, even if inflation number slows the rate of change, it's still the absolute number has got higher and that's unlikely to come back down.
Yeah, and there was some data that I saw for the local area here where some basic foodstuffs have gone up 20% in the last quarter. I mean, these are huge numbers. No wonder households' budgets are under pressure. And we're seeing just more and more people struggling to try and make ends meet. And the Reserve Bank's solution is don't ask for high wage rises. That doesn't feel to me the right solution. And, we are in a very uncomfortable position at the moment, as with many other Western countries. I just wonder whether the Reserve Bank has the real ability to handle this with such low levels of confidence. I think households need to take their own initiative, look at their own budgets, start making their own financial plans themselves. Don't expect a get out of jail card from either the government or from the Reserve Bank. I think we're going to go through a very complex couple of years. Lower house prices, lower asset prices, wealth destruction. And the fact of the matter is, I think people will find that they're going to go backwards rather than forwards over the next couple of years.
Yeah, and little subtle changes, Martin. I had to have a laugh when we talk about the the central banks in their basket policy, basket of goods, and substituting one for another. And are you okay with KFC using cabbage instead of lettuce and that type of thing, Martin? That's what they're trying to target?
Yeah, it was exactly right. So and people do that. They go for cheaper versions, and people make logical decisions. I actually think that people aren't given enough credit for managing their own budgets well. But what I would make the point is that many people don't actually have enough insight to their own spending patterns. So build your own budget, see where things are, and see what you can do in terms of just balancing some of these things. There is no simple solution from where we are at the moment, and I don't think we're going to be able to watch the cavalry come over the hill and sort of solve this for us. This is going to be a hard grind, and as somebody who lived through high inflation in the 70s, I just know how bad it is and how it really can erode lifestyle and everything else. The other point, of course, is that debt then becomes a huge burden, with high interest rates. And we've got ourselves used to huge amounts of debt. And, everybody's being thrown debt, whether it's buy now, pay later, mortgages, whatever, right? Sometimes debt is not the solution. Less debt is better.
Awesome. Well, guys, as always, links to Martin's channel down below. Like, share, subscribe, share the video around. Now we're back into these monthly, and we'll talk to you again next month. Thanks, Martin.
Cheers. Bye-bye.